Right, so the mistake I made was I discounted that next period's dividend back 1 year, which we weren't supposed to do. Right, so the perpetuity formula actually typed out right there. I think I typed out the formula of that class as well. For perpetuity is the next year's payout divided by the growth adjusted discount rate. All right, so that brings us to stock price of $35. So I just wanted to correct that as came to my attention. Any other questions before we get back to class?
Yeah, was that the one that was growing by 2% each year? Is that what you said?
Yes. So there's two of those questions, right? So in the first example, we have a $1.75 dividend being paid out next year and then growing by 2% per year. So that's the $35. And this next example, the $1.75 dividend was paid out today. But remember, the value of any asset is the future expected cash flows it's going to generate. Right. So if a cash flow already took place, it's a sunk cost. It's not relevant to the value of the asset. So we need to calculate the next year's dividend being paid out, which is what we're doing in this next example here. But yes, they're both growing by 2% in perpetuity after that. Any other questions?
Yeah, I just I can't see what you're doing. Are you sharing screen or?
Oh, nope, I hit record and then. Thank you.
Oh, okay, thank you.
Right, so it's just following along with the formula that I had typed. The next period's cash flow divided by the growth adjusted discount rate.
Appreciate it.
Yep. Actually, this would be better notated. Cash flow at time plus 1, the next period's cash flow. All right, so the difference between this first and second example is in the second example, the dividend was paid out this year, but again, only cash flows that are relevant are future cash flows, not sunk costs, not sunk cash flows being generated. So we have to estimate the next year's dividend being paid out by taking this year's, multiplying it by 1 plus the growth rate. That gets us the next year's. Any other questions? All right. So we ended around valuing stocks again, right? So these first two examples are going to be pretty similar to what we've seen. Let me just double check. Yeah. It goes around here, right? So there's a formula that we can use to calculate the value of a stock in one single formula. But as we'll see when we look at a cash flow table, it's much easier to put a cash flow table together. This is what you've been working on in the DCF section on your problem set. All right, so let's go through, do a couple examples here. All right, so let's say that stock is going to pay an $8 dividend next year. It has a price of $172 at the time, discount rate of 8%. What is the price? All right, so in other words, we're forecasting the stock is going to have a price of $23. It's also going to pay out $8 dividend. So we have to figure out the present value for this stock. All right. So there's two ways that we can go about solving this. We can solve it with the formula or with the Excel function. Either is going to get you the correct answer. All right, so we're going to be doing a present value problem here. All right, the rate is going to be 8 years. The number of periods, I don't have it put in there, but it's just going to be 1 year. Right, then we're going to have an $8 dividend and single cash flow 173. That gets this total present value of the $181 of 160 cents. Keep in mind when we're calculating about it, it's important. Oh, whoops. I missed the comma there. There we go. It's always important that we have the negative sign on the same present or future values. Right? If I were to put a positive sign on the payment and leave the negative sign on the future value, we're going to get a different answer. Right? So very important that we always have our negative sign appropriate line to either all future cash flows or all cash flows. Firm just paid $2.50 dividend. What's the price of this stock going to be if the dividend grows at 4% per year and the company has an 11% discount rate? All right, so we just saw reference to an example very similar to this when we were looking at time value money. So can you all walk me through the steps now for getting the price?
Yeah, so that one should be the 250 times 1.04 over the discount rate minus the growth rate.
Exactly. So we get that 1.04. What he's doing there is taking the base dividend, right? And in order to get the cumulated, we multiply that base dividend times 1 plus how much that dividend is growing by. That's where we got that 1.04. So it gets us a price $37.10. Right. If you're ever in doubt, we always have the formulas to rely on, right? Under our course notes. All right, we have the formulas that we need outlined by all the sections, right? So you can always go to refer to those if you need help remembering what formula you have to be using to solve a given problem. All right, so now we're going to be dealing with some more cash flows, right? Like in the PowerPoint last time, there is a formula that we can use to solve for growing perpetuities, particularly across multiple growing stages, right? That's one of the common ways to handle companies' cash flows. Right? If you're not dealing with a company that has a stable cash flow, you basically forecast that company's growth at its current growth rate, and then assume that at some time in the future, it is going to be growing at a relatively more stable rate. And then at that point, it's growing in perpetuity. Right? So basically, multiple years of different stages of growth. So one of the ways that we can simplify this and try to figure out the value of multiple streams of different cash flow growth rates is to use a cash flow table. Right? Remember, there's 4 steps for setting up a table. What are those 4 steps?
Set up the time periods first, then put the cash flows in their respective time periods.
Yep. So those are the first 2 steps. Third step.
The discount rate, or
We set up our discount factor and then take all of our present values in each year. And the 4th step.
sum up the values.
We're going to be summing up all of the present values. Exactly. All right, so that's what we're going to be doing here, right? But like I said early on, things can get complicated pretty quickly when we're dealing with cash flows. And this is going to be one step going in that direction and just seeing a little bit more complicated on how cash flows can be. All right, so far we've been at this stage where we're assuming we're already growing in perpetuity at a given rate. Right, but very often we might be dealing with a cash flow stream that's not at that point, right? Especially if you're dealing with a younger company. That's part of the reason you use older, more established companies, because it's a lot easier to forecast for them, right? Companies tend to grow at a little bit more of a stable rate as they age. The younger the company, the more volatile its cash flows tend to be. Right, so we're dealing with a company that just paid out a $4 dividend, and we're going to be looking at it growing in different stages. So it's growing relatively rapidly for 2 years at 8%. Then it's slowing down a little bit, growing at 4% for 4 years, and then growing at 2% in perpetuity. Right, so the problems we've been dealing with so far have just been using this 2% in perpetuity. Right, this is basically the cash flow frame we've been dealing with. But in this case, we have 2 additional stages of growth. Right, so the only difference here is we're still going to be this dividend growth similar to as we have been. The only difference is we have to be very careful with our timing. Right, when a cash flow occurs matters to the value of that cash flow. All right, so step 1, we set up our time period. Step 2, we set up our cash flows. Right, so the dividend was just paid, meaning it's occurred in time 0. And from here, we're going to grow it and figure out its value moving forward into the future. All right, so at first, it's going to be growing at 8%. be growing at 8% for 2 years. So we're growing at 8%. And we're growing at 4% for 4 years, and then 2% in perpetuity. Right. So this 2% in perpetuity, we're going to be using that down here in the future value, right? We're going to be able to, since we're now growing at a continuing value, we'll be able to calculate that 2% growth in perpetuity. We just need to get up to that final year's cash flow. All right, so now we're growing at 8%. So copy and paste that over, update our reference. So we started at $4 being paid out this year, growing at 8% for 2 years, and growing at 4% for the next 4 years. So now we've gone through these more unstable cash flow growth periods. In this 6th year, when cash flows start to grow at a constant rate, now we can use this perpetuity formula that we've been using so far. All right, so now what's happening is this $5.46 is going to be growing every year at 2%. So when we reach this constant growth stage, this is when we can use the perpetuity formula to value this cash flow. All right, so now we're just going to use that perpetuity formula that we've been using. All right, we take this year's cash flow, multiply it by how much that cash flow is growing by, and that's going to get us the dividend being paid out effectively in the 7th year. Right? Remember, the value is always based on the future cash flow. So if we're in the 6th year, the cash flow that's relevant is in the 7th year. So the 7th year cash flows would be $5.57. But from here, we have to adjust for the perpetuity value, right? The growth adjusted discount rate. So it's going to be discounted at 10%, the 2% growth rate in perpetuity. So the value of that $5.57 growing at 2% in perpetuity, $69.59 in year 6. All right, but keep in mind, timing matters. The $69.59, this is 6 years into the future. So obviously we have to adjust for the time value of money again, right? So the $69.59 is relative to year 6. So we got to discount it back still. All right, so we're going to set up our discount factors. All right, anyone remember the formula here?
It's the 1 times the discount, right?
Not quite. Not quite, right? When we're dealing with the discount factor, right, it's going to be, we're taking a present value.
Right. Oh, yeah.
So we have our future value set up here, right? We have streams of cash flows. I guess we should say the sum, right? The sum of the cash flows. So we have our future values up here, but we need to discount them, right? So what did we do to discount those cash flows?
It's the first one will be $4.32 divided by 1 plus the discount rate to the year.
Yes. Yeah. So that is effectively what's going to be happening when we calculate the present value, but specifically for the discount factor, right? We can also break up the present value into 2 components. Right? In other words, 2 rows. We have the future values, which we have with the dividends in the future value, and we have the discount factor. Right? So the present value is the combination of future values adjusted for time value, which we use the discount factor for. All right, so following along with this formula, our discount factor is going to be 1 divided by 1 plus our discount rate of 10%. Set reference and right? And our discount factor should always be equal to 1 n times 0. Right? And moving forward, we should see that it's decreasing across time, right? And that's time value of money in practice. The further out in the future we receive our money, the less it's going to be worth today, the more we're discounting it. Right? For the only relevant cash flows, for future cash flows being received. Right, so we're gonna sum up these cash flows that we're receiving in the future to get our total cash flow, right? This doesn't matter at first because there's no future value here, but it is gonna matter in year 6. Alternatively, you can just add in that $69.59 in that 6th year. Either format, either method is gonna get you the same answer. However you prefer calculating it, will get you there. So, so we get present values now, right? Notice the present values jump up in that 6th year. Right? The reason being is that much of the value of an asset comes from the value it's generating in perpetuity, right? After we get this total value, $60.50, let's see how much of that value is coming from that lump sum that we're getting in the 6th year. Right, so the value of dividends actually
Dr. Jansen, can you hover over like the first year's discount factor again?
1 divided by 1 plus the discount rate. Fix that reference to the discount rate and then raise it to the year that it's in.
Gotcha. Thank you.
Yep. So I'm just going to do a little here and copy this value. There we go.
Could we see that again?
Yes.
Thank you.
What exactly do you want to see again?
F30. Oh, you're just adding up the totals of those.
Yep.
Gotcha.
Yep, that's the final step of any discounted cash flow problem, summing up all those present values. Only thing I'm doing here is trying to give you an idea of the proportion of where that value is coming from in this example.
Could we also then see just F31 and F32 then? It's just a little tough because I'm trying to process the formulas and understand those as well as also seeing what you're doing.
Sure. So, right, with the price, it's the sum value of all the discounted cash flows. What I'm doing here with the present value of the dividends and the perpetuities is just getting the present value of the perpetuity and the present value of the dividends. All right, so once I add back this dividend here, right, we see the sum value of the present value of dividends and the present value of the perpetuities is present value for the asset. Right, so the present value of the dividends here, I broke the formula here just so I could have the number without updating what I was copying over here. Basically, what this present value of dividends is summing up the value for all the dividends in the asset. Actually, might be a good idea for me to explicitly show this in another example here. There we go. Now I've got it updated. Fix these references. All right, so I gotta just copy and paste this future value since we're basing it on this $5 actually. So what I'm doing here is I'm just breaking the formula. When I paste it, I'm going to paste values and just getting the value. The reason I'm doing that is because when you're using referenced formula calculations, right, they're all going to be dependent on one another. But since I'm trying to separate out these cash flows, I want to break that link. So I'm individually showing the value of the perpetuity stream and the value of the dividends paid out until that perpetuity stream is complete. All right. So in this first example, we're getting the sum total value of all of the dividends plus the value of those dividends in perpetuity. All right, so basically we have two types of cash flow streams going on here. We have the dividends themselves, and we have the value of those dividends in perpetuity. So the sum value of those two cash flows is $60.50. Right, 21 of those dollars are coming from the dividends that we're receiving over those 6 years. And just under $40 of that value is coming from that dividend stream in perpetuity, growing at 2%. All right, so if we're just looking at the present value of dividends, we would do exactly what we did with that growing cash flow stream. The only difference is we're not including the perpetuity value of those dividends, right? So that gets us that value that we calculated, $21.22. Right. The value on the perpetuity, on the other hand, we exclude those dividends that we are using and just get the value of those dividends in perpetuity from the 6 year. Right, because it's 6 years from now, discounted at 8%, that's only going to be worth about 56% of its nominal value. In other words, it's going to only be worth $39 today. All right, so we have these two cash flow streams that are relevant to this one asset. The dividends that we're receiving over the 6 year period, plus the value of those dividends in perpetuity growing at 2%. So in other words, 35% of this asset's value is coming from these 6 years of dividends. And conversely, 65% is coming from the value of that perpetuity indefinitely. All right, so we do have the most dividend growth rate early on in this cash flow table, right? But most of the value of assets, if they're growing in perpetuity, if you're getting cash flows projected indefinitely, then most of the value is going to tend to come from that perpetuity stream. All right, any questions?
Yeah, Dr. Jensen, can you show the formula line for PV E29? Just trying to see what it was.
So the present value is the future value. So in this case, the dividend plus that lump sum perpetuity value, which is 0 in year 1. Make sure you close the parenthesis there after you sum them up and multiplying that by our discount factor.
Okay.
Right, there's always two components when we're valuing something, the cash flows and the discount value that's being applied to those cash flows. Right, always remember the what an asset is defined as, what the value is, the expected discounted future cash flows. So we have our cash flow stream, we have our discount rate that we're applying to those cash flows that gets us our present values. The asset then is just the sum of all those cash flows. Any other questions? Okay. So one of the cool things about this formula, we'll place that, now we can make that as cash flows. With valuing something in perpetuity using this pricing formula is this, right? We can get the cost of capital by itself. Right? So if we wanted to solve for the cost of capital, basically arranged as the discount rate is equal to, copy this down, the cash flow divided by the price plus the dividend growth rate. All right, so in other words, we can estimate what the cost of capital is for a stock if we have information about their cash flow, particularly about typically this sort of arrangement is just going to be used when we're looking at dividends. So if we wanted to figure out what the expected cost of capital, or particularly the expected cost of equity is going to be, we can rearrange this price formula in perpetuity to get that the expected return on equity to the next period's cash flow, or in this case, the dividend, divided by today's price plus the growth rate. So if we're looking at a perpetuity, this is pretty simple, right? There is no growth rate. All we're doing is we're dividing the cash flow divided by the price. That gets us the required return, which, in other words, is the expected return. All right, now let's bring in a growth rate. Let's say that a $1.50 dividend was just paid out. It's going to be growing at 3% a year. That's a price of $23. What's going to be the expected return on this? All right, so again, whenever you see just paid, whenever a cash flow has already been paid out, that's not relevant to the value of the asset, but we're using it to project the future cash flows that are relevant to the value. All right, so the first step here is getting that next period's cash flow. So we get that dividend multiplied by 1 plus the dividend growth rate and divided by today's price. All right, so that's the first step, getting us 6%. Right, but there's one important component we have to add back in again, which is the growth rate. Growth rates can add a lot of value for an asset, especially in perpetuity. Right, so this is basically just the method. It's the Gordon growth model. All it's doing is rearranging the perpetuity formula to arrive at the expected return based on cash flows. This is particularly used for dividends, right? So we could just substitute those dividends in there for the cash flow. But it's one of the methods we can use for estimating the cost of equity to a stock. Any questions before we move on? All right, market efficiency is something that is has been and continues to be a really important part of financial economics. Right? It's one of the earliest tests using actual financial market data to evaluate, is this actually efficient? Right. So what does that really mean? What an efficient capital market means is that security prices reflect all available information. So how that information is defined is very important. But basically, once relevant news is released, then that information is computed into the security price for an asset. Right. So coming out of this idea of there being an efficient capital market is the efficient market hypothesis. And this is basically just that stock markets are efficient. Right. And like I said, depending on how we define information, there's a few different forms of market efficiency. I think I copied, I copied that in the wrong part. So the first is weak form market efficiency. So this is basically just when security prices reflect all historical information. Right. In other words, it means that you can't predict next period's return based on, or tomorrow's return based on what today's return looks like. That's typically how we go about testing. So weak form market efficiency means prices reflect all historical information. And then we have semi-strong form. Basically, each type of market efficiency builds on the last. Semi-strong form is weak form plus all available public information. So it's going to be all the historical information of the stock plus everything that is currently happening with the stock, everything available in its financial statements, and that's continually updated daily. And then finally, there's strong form market efficiency, which is semi-strong form plus weak form, all private information on the stock. Basically, what strong form market efficiency is looking at is basically, can insiders earn abnormal profits on their trading decisions. So basically, there's mixed evidence across the board on market efficiency. So in strong form, markets are mostly not very efficient. There is a lot of evidence that insiders are capable of earning abnormal returns on their decisions to invest in the company that they have insider information on. Right, that's part of the reason that there are so many laws restricting insider trading, or at least attempting to, is that these insiders have material information that is relevant to the value of their securities. So basically, it's giving these people an unfair informational advantage. Right, knowledge is power, and in financial markets, that is absolutely true. If you know something that nobody else does, you can. Right, so there's been a lot of evidence that strong form market efficiency doesn't really hold. Semi-strong form, it weakly holds. There is some evidence that we can use public information to predict future returns. That's one of the articles that I have provided. Actually, I just started opening up for discussion forums. We'll talk about it at the end of class. So there's mixed evidence on semi-strong form, but for the most part, it points to that not holding up too well. And then there's weak form market efficiency. And this is probably the form of market efficiency that there's the most support for. Typically, we cannot predict next day's returns based on the returns today, or next year's returns based on the returns this year. So using the security's own price, there's very little information in it. And for the most part, weak form market efficiency holds. Some specific areas where it doesn't hold. That's where one of the first articles that I had published looked at actually is in testing weak form market efficiency and basically showing that stock returns don't follow a normal distribution like most of our models assume. Basically, what it follows is called a leptokurtic distribution, meaning that most returns are very narrowly aggregated around zero, but then it has very tails, so very high lows, very high negatives, very high positives. Right, and so basically what I see is that in those tails, there is actually evidence that weak form market efficiency doesn't hold. So for the most part, when the market is trading, which it does most of the time, day to day, around zero, then we find that weak form market efficiency tends to hold. But when we look at the tails of return distributions, there is evidence that we can use security returns to predict the next day's return performance. And so for the most part, evidence suggests that weak form market efficiency holds, at least on average. That tends to be the case. Semi-strong form, mixed results, mostly pointing to it not holding. Strong form, it doesn't hold. We've had consistent evidence that insiders are capable of capitalizing on the information that they have held privately. Right, so what should market efficiency look like? So basically, this is just a diagram or hypothetical stock that if there is information coming out, it has an effect on the company's security price. So if the fair value was $140 before this information was released, and then with that information released, it's then worth $180, the perfect way to react is for that price to jump to 180. But we tend to see in actual financial markets, that's not really how they react. Oh no, I'm getting a message that my connection is unstable. My internet has been giving me problems, as we saw last week. So anyways, in actual markets, there's a lot of evidence that there's both overreactions and corrections and underreactions. So with the overreaction, basically what happens in the market is they overreact. So a great example of this being the start of COVID-19. Right, markets started plunging. We have never seen a bear market happen so quickly in such a short time and rebound almost immediately from it. Right, there was significantly negative reaction. There were terrible economic and humane consequences from the pandemic. At the end of the day, it wasn't what the markets predicted exactly would be happening. Right, so in other words, the market overreacted. There was actual negative information that occurred, but it wasn't quite as negative as people had initially predicted at the start of it. So that tends to happen most often in environments where there's not a lot of information available, right? Such as the start of a pandemic. If we don't know what we're dealing with, there's a lot of uncertainty. We don't know what's going to happen. So in cases of poor information environment, markets have a much stronger tendency to overreact to bits of information and then correct it. In other words, rather than shooting up to the correct $180, maybe it'll drift towards 220, but eventually drift back down to the 180. So in situations where there's a lack of market information, overreaction tends to be the case. On the flip side, when we're dealing that has a lot of information available to it, right, such as corporate structure changes, complicated cash flows that companies are dealing with, there tends to be a delayed reaction. So when there's a lot of information available, actually, it takes markets a little bit of time to adjust to that information and then pound it into the price. Right, so the two states that we often see to information releases are overreactions and corrections, typically in poor information environments, and delayed reactions or slow reactions, which tend to happen in information-rich environments. Right, both happen pretty frequently when you're just looking at the stock market, but very often it tends to be tied to what sort of information environment is around that news release. This is everything I was just talking about. All right. So this is something that I know you're going over in Dr. Shirley's class, so it's something that we're just going to touch on very briefly, because we have other things that we're going to be focusing on. All right. So what is risk and what is important to our models in predicting expected returns, right? Putting together our discount rate that we're going to be applying. So the two basic ways that we can look at risk is through unsystematic or idiosyncratic risk. And this is risk that is particular to a single asset or a small group of assets. And the important aspect of it is that it can be diversified away. Right? One of the most well-tested ideas in financial economics is the value of diversification in your portfolio. Right? If you hold on to a single security, that security can be extremely risky. But if you hold on to a diverse portfolio of securities, that diverse portfolio tends to be much less risky than the individual riskiness of all the assets in the portfolio. Right? Which is, so one of the benefits of having a highly diversified portfolio, basically holding market-based ETFs, mirroring something like the S&P 500, is you have a broad pool of securities, basically more than 30 securities held in a basket in a portfolio. And above that, you've basically diversified away the unsystematic risk of the individual securities held in that portfolio. Typically, how we measure unsystematic risk is the variance or standard deviation of those assets. And then we have systematic risk, or in other words, market risk, total risk. And this is going to be risk that affects most or all assets. And it's something, and this is the important takeaway here, is that it cannot be diversified away. All right, so the general idea is that because unsystematic risk can be diversified away, it's not relevant to investors. It's not what they are going to be so concerned about, because if an investor wants to get rid of that risk, they can just purchase a couple more investments, diversify their portfolio, and get rid of this unsystematic risk. Systematic risk, on the other hand, since it cannot be diversified away, it is the risk that no matter how large your portfolio, there is still going to be some underlying risk in it. Since it can't be diversified away, that's going to be the risk that is most relevant to investors. And the way that we're going to be measuring that is through beta, right? Beta that comes from the capital asset pricing model. So how do we measure beta? Basically, it's going to be a measure of the relative volatility of an individual asset relative to the overall market. So the way we do that is looking at the covariance of the one asset's return relative to the overall market divided by the variance of the market returns. Right? So the basic idea is the more an individual asset varies relative to the overall market, the higher the beta, the more risky it is going to be. Right? So the higher the beta, the higher the risk. So if beta is equal to 1, that means that you're just exposed to about market level rate of risk. However, if beta is less than 1, you're dealing with less risky assets, and if beta is greater than 1, with more risky assets. Right? So this is where the risk and return relationship tends to show up. As we have more risk, we should have the return. So as we have higher betas, we should expect to see higher expected returns, and this is what we get out of the capital asset pricing model. So this is just a graphic diagram that reflects the capital asset pricing model. Right, so this is CAPM right here. The expected return of any assets can be equal to the risk-free rate plus the beta times the expected market return the return that we're using to calculate the covariance of this individual asset's return with the overall market, minus the risk-free rate. Right. So what we see here in the security market line is just the association between the expected return of the asset and the riskiness of that asset. So as risk is increasing, the expected return on assets are increasing as well. Right? In other words, expected returns are increasing in the amount of risk the assets have. So basically what's going on with the capital asset pricing model is we start off with the risk-free rate, 0 risk. Right? So since we have no risk, this is just reflects the pure time value of money, the base rate that people need to forego consuming something a day. Right? Generally speaking, people have very strong time preferences, meaning they prefer things to happen now. Right? If someone were to tell you, would you rather have $1,000 now or a guaranteed $1,000 a year from now? Pretty much everyone would take that $1,000 now, right? There's a pure effective time value of money that even if you were guaranteed the income in the future, that income is still more valuable today, just because, right, there's more things you can do with it over that year, right? So there's a pure time value of money effect. That's what we get from the risk-free rate. From there, we add on the amount of risk. So the more risk you have, the higher expected return you're going to have. But what is generating that return is the market risk premium, the spread between the expected market return overall and the risk-free rate. So the higher market risk premium is, the higher the spread between the market return and the risk-free rate, and the higher the overall return for the individual asset is. So again, just digging into the formula a little bit more. Right. With the risk-free rate, investors need to be compensated simply for not consuming something today. And that's with the risk-free asset. From there, we add in the amounts of risk, the amount of risk through beta, measured as the covariance between the returns on the individual asset and the returns on the market, divided by the variance of the market return, multiplied by the market risk premium. All right, so we have 3 inputs with CAPM that we know are relevant to investors: pure time value of money with risk-free rate, the amount of risk through beta, and the market risk premium, how much investors are earning for bearing risk. Right. So similar to people not wanting to, or similar to preference to preferring money now relative to sometime in the future, investors aren't going to want to invest in risky assets for nothing. Right. If you were to say, hey, you can have $1,000 now, or a 50% chance of $1,000 next year and a 50% of nothing, right? That means your expected value is lower. Actually, that's not a good example. Or a 50% chance of $2,000 a year from now, or a 50% chance of $0 a year from now. Right? Pretty much everyone, again, is going to take that $1,000 today. Right? There's no risk in it. People prefer cash in hand. So in order to entice investors to hold on to risky securities, there's got to be some sort of market risk premium for holding on to that risk. And that's basically what we're dealing with the market risk premium. All right, if you offered someone the opportunity between maybe $1,000 today and a 50% chance of $4 in a year, right? Then this starts to become something that someone might reason out, right? The expected value of a 50% chance at $4,000 is $2,000, right? So right off the bat, right, nominally we see that there might be some value in that exchange. That is an exaggeration, right? That's typically not how security markets are going to work. Typically, it's a little bit more volatility, but more likely to recuperate at least your initial investment if you hold on to an asset long enough. Actually, this is just repeating what I had said. All right. So again, important things to keep in mind here with beta is if we have a beta equal to 1, that just means that it's reflective of overall market risk. Less than 1, you're dealing with a security that has less risk than the overall market, so its expected return is going to be lower than the expected return on the market. If you have a beta greater than 1, suggests that security has higher amount of risk. Investors are going to have to be compensated. And so expected return overall is proportional to the amount of risk in a given security and the market risk premium. Those main components that are building up expected returns, especially when we see that risk-free rates are as low as they have been. And with low risk-free rates, then again, much larger proportion of expected returns are going to be generated out of the amount of risk and the risk premium for bearing that risk. One additional way we can evaluate this trade-off is with the reward to risk ratio. All right, so the reward to risk basically is one of our metrics we can use to gauge how well investors are being compensated for bearing risk. A pretty simple formula. All we do is we take the expected return of the security through using CAPM minus the risk-free rate and beta of that security. All right, so what we're getting here is how much are we earning for any given amount of risk. All right, so when we're dealing with individual assets, overall, what we would be looking for is higher reward to risk ratios. So just a very brief example, if calculate expected returns using CAPM. So let's say that a stock has a beta of 1.3, expected market return is 12%, the risk-free rate is 2%. What's going to be the expected return for the stock? All right, so with CAPM, we have the risk-free rate plus beta times market risk premium. All right, so all we have to do is plug this information in. We have the 2% risk-free rate plus beta of 1.3 times 10% market risk premium. That would give us an expected return of 15%. Very important to keep in mind, CAPM is very often used. You're going to see this in one of the other papers that we're going to be looking at. I think next week we'll start looking through it. CAPM is used by a vast majority of CFOs. I think around 80% of CFOs use CAPM to estimate the cost of capital for a company stock when they're trying to figure out the company's discount rate. So CAPM is used all the time. Very nice thing about it is it can be used on any given asset as well. Right? Some models are used specifically for stocks, some for bonds. CAPM is applicable to any asset. So long as we have some sort of return, observe or estimate, use CAPM to value the expected returns for an asset. But that being said, it is often important you know it. There are some caveats to it. It's a very nice theory. Still, economics is considered one of the most beautiful theories in the field because of just how well it encapsulates so much valuable information and how easily it breaks it down. In the data, though, it doesn't hold up all that well. In other words, it doesn't do explaining stock returns. There are a lot of assumptions that we didn't go into that have to be made in order for it to work. For investors, meaning that investors all have the same risk profile, they all have the same preferences, they all have the same lifespans and investment portfolios. So we know that's not the case. There's have perfect access to information. Again, there wouldn't be insider trading if everyone had access to perfect information. So there are a lot of assumptions that are necessary to derive CAPM. And it's also difficult to define what exactly the parameters are. And that's something that we're going to get into more when we look in the model next week. But basically, when we use assumptions that are going into models, there are a lot of little things that we can change that result in significantly different outcomes, right? Like we saw with changing the discount rate. Right? Small changes to discount rates can lead to orders of magnitude differences in net present value forecast for a project. Right? So same thing with CAPM. Right? There's a lot of different risk-free rates we can use. There's a lot of different ways we can actually measure beta in practice. The standard that you're probably going to come across most is measuring beta at the monthly level over 5 years, but it could also be at the daily level over 1 year, over 2 years, 5 years, at the annual level. What do we define as the expected market return? Typically, it's the S&P 500, but there are so many more stocks listed in just the US alone, let alone ignoring stocks all over the rest of the world. Right, so there's a lot of assumptions that go into it, and defining what exactly we should include in CAPM can be pretty difficult. But in spite of all of these issues with it, it's still very commonly used. Biggest reason why it's used is it's very easy to use. It's better to have a guesstimate for what sort of discount rate we should be using. But at the end of the day, very important, right? Despite being mathematical and being defined under very specific conditions, CAPM is just a theory, and in practice, it doesn't. So very important to keep all those in mind when we're using this. This is the slide that we were finishing up from last week. Any questions before we move on? All right. All right. So companies are trying to maximize their value. Right? If companies have unlimited resources, then invest in every single positive net present value project that they come across. Every single project that's going to add value, they should invest in. But all companies have limited resources, right? So in spite of companies having a lot more resources than us as individuals, they still are limited in the amount of resources they have available. They also might have limited projects that they can pursue, right? So by having limited resources, companies are going to have to figure out how to allocate those resources in the most efficient way possible, meaning in the most value-adding way possible. So the best way that we can do this, and this is going to be the most important role of the finance arm in a company, is to evaluate how those resources can be most effectively allocated. And the way doing that is through capital budgeting. And this is the process of allocating capital to the investment with the highest expected payoff. Right. So in other words, we have limited amount of money. So we're trying to figure out how we allocate that money across investments with the highest expected payoff. There are different ways we can define payoff, and we're going to look at some of those ways. But basically, the end result is going to be net present value. It's going to be the best measure of payoff. All right. So in other words, we're going to try to allocate our capital to the projects that are generating the highest NPV. So how do we measure value? Like we started off this class, we're measuring value as free cash flow. There's a few different ways that we can measure it. We can use the bottom-up approach. You'll see this most frequently used, largely in part because it's the easiest to calculate. Right? This is all blanket information that is observable in a company's financial statements. We can start with the net income from the income statement, add back depreciation and amortization. That's going to be reported on either the income statement and or the cash flow statement. And we net out changes in net working capital. That's going to be taken either from the cash flow statement or the balance sheet. And capital expenditures. That again is either going to be taken from looking at balance sheets or a cash flow statement. So all this information is readily available. Similarly with the operating cash flow method, calculating this. So operating cash flow, basically it lumps together depreciation, amortization, net income, then we net out change net working capital expenditures. And then we have the depreciation tax shield method. So this method is not as commonly used, but it is a more technical representative measure for calculating free cash flow, particularly because it adjusts for true cash flows that do occur. And notice the difference here where we're adding back depreciation and amortization for free cash flow, but we're adding back the depreciation times the tax rate for the depreciation tax shield approach. All right, so what we're doing here is going to be similar and gets you close answers to the bottom-up approach. All right, so we start off with the sales, then we net out our cost and selling general administrative net of tax. We add back our depreciation multiplied by the tax rate. All right, so the reason that we're multiplying it by the tax rate, depreciation actually does give us flow by reducing our taxable income. All right, so by reducing our taxable income, depreciation is giving us a tangible cash inflow because of the reduction in taxes that we're paying out. All right, so notice that all of these values over here are the values prior to adjusting for depreciation and amortization. Right, sales is top of the income statement. Sometimes depreciation and amortization can be lumped into selling general administrative or cost of goods sold. If that is the case, then it would have to be netted back out from these if they are lumped in, and multiply that by 1 minus the tax rate. And then this depreciation tax shield here is showing us the amount of taxes that we are saving by our depreciation expense. So the higher our depreciation, the lower our taxable income, the lower the taxes that we'll be paying out over a given time period. All right, so this is technically the most accurate of calculating free cash flow. It is a lot more tedious, and in part for that reason, companies tend to focus on the bottom-up approach. And this is probably what you'll be using for the project. So how do we go about calculating free cash flow? So change in net working capital. If we're dealing with a company as a whole, as you will be for your project, it's actually pretty easy to calculate change in net working. You're going to get it straight from their financial statements. But if you don't have access to that, then you can calculate it yourself using 2 years of balance sheets. One important distinction between valuing a company as a whole and an individual project is net working capital basically canceling itself out over the course of the project's life, right? So in other words, we plan on paying off all the people that we borrowed supplies on credit. So we're going to pay off those credit, and we're all the sales that we made on credit, right? So in other words, the accounts receivable, we're going to receive our money for that. Right, so that's the zeroing out of net working capital that I'm talking about here. We're going to pay off our debts and we're going to collect what's owed to us. So we're zeroing out net working capital over the life. But as we'll see when we look at what happens to change net working capital is when we adjust balances in there, we can actually add value. And that's actually part of the reason for the supply chain crunch that we saw during COVID, right? Having lean supply chains is one of the methods that companies can use to increase their free cash flow. But as we saw, right, it left a vulnerability to the production system. But the reason that we had that supply chain crunch was that companies were trying to maximize their value. They just didn't foresee a circumstance in which supply chains would get so bungled that that lean supply chain would in itself cause a lot of problems for the company. Right, so changing net working capital. This is a really relevant bit of financial management. It's something that can have tangible effects on values of companies, and something that we saw play out over the course of the pandemic with supply chain crunches. So the easiest way to make this adjustment for zeroing out net working capital is to plug in net working capital at the end of the life. So basically all that means is you add up the nominal values of net working capital, and then you plug in, or in other words, do the opposite of what those values add up to. So if over the course of the project, your change in net working capital summed up to say $1,000, you would subtract $1,000 in the last year just to reflect zeroing out all the accounts, paying off what your suppliers and collecting what is owed to you. All right, depreciation. So there's two typical methods of depreciation that are used. It's either going to be straight line depreciation. That's going to be the easiest to calculate. That's just how much we spend on an investment divided by the investment's expected lifespan, or using the depreciated tax shield, the accelerated depreciation schedule. Right? What we do there is we capital expenditure, multiply it by the depreciation rate that will be on that table. So when we're evaluating cash flows, we're only including the cash flows that are going to be relevant, right? So in other words, the incremental cash flows that a project are going to be generating. And so basically when we're dealing with the project evaluation, what those incremental cash flows are going to be are the difference between the company's cash flows with and without accepting that project. So in other words, all cash flows that are directly attributable to whether or not the company accepts the project are going to be the incremental cash flows and are relevant to that cash flows value. Another important thing to consider is whether or not the project is going to be beneficial, right? So in other words, is it meeting our internal requirements for accepting a value-adding project based on whatever valuation technique we use? And as we'll see, we should get similar answers regardless of the valuation technique we use, but it's often a good idea to use multiple capital budgeting tools. In addition to figuring out what relevant cash flows should be included in valuing a project is the standalone principle, right? And so this is just the idea that when you're valuing a project, you value just that project itself. So in other words, how much value is being created or destroyed should the company accept this project? One caveat to this is including erosion. Is erosion, right? So basically you could think of this like when Apple releases a new phone every couple of years, typically those new phone sales take away from their existing phones sales, right? So that is something that can be considered, and in many cases is when companies are evaluating a different project. Another important aspect to consider is what's called the sunk cost, right? Or I should say something that should not be considered, but important to be aware of, right? So a sunk cost is something that's already occurred. Very important to keep in mind that the value of an asset, the expected discounted future cash flows. So in other words, cash flows that have not yet occurred. If a cash flow has occurred, it's not relevant to the valuation of that cash flow, right? So in other words, if you're dealing with a project that historically has generated a ton of, but things have changed and it looks like it's no longer going to be generating value. Based on that future projection, should we use that history of very positive cash flows, what we now know, a negative cash flow future? No, right? So sunk costs should not be included. It applies to time and money spent to valuing a project itself, right? Very often, once people start working on something, they grow attached to it and they want to see it through, right? So if a manager has spent a lot of time and money evaluating a potential project to invest in, often they'll have the incentive that they really want to get this project going on, right? But all of the time and effort that's been put into evaluating a project is a sunk cost. So in order to make the best decision that we possibly can, we ignore all costs that have been incurred. We ignore the past other than what is relevant to projecting and predicting the future, estimating the future. And we leave the past where it is. It is not relevant to the value other than forecasting what the future cash flows and discount rates we should be applying to it are. And then the sunk cost fallacy is ignoring or failing to ignore sunk costs, right? People have a very strong tendency cost. And actually, I just happened to watch an episode of Seinfeld with my fiance, and it perfectly captured this. So I want to go play that. Got to unplug my headphones for this. Let's see. It also includes a financial principle at the end of this that is relevant to class later too. So it's perfect.
I know this guy, I'm getting all my sneakers at a discount now.
I know, you mentioned it.
Oh, yeah, right. Oh, God, get me out of here. What a mistake. What made me think this would work? And I've a day. I've got nothing left to say. Wait, got one. That's a nice watch. Do you wind it?
No, it's got a little battery.
Well, that's good. Well, the drive home should be a delight. I'm speeding the whole way. Let him throw me in jail. I don't care. That's the manager. Do you want me to get another room?
No, it's okay.
I guess you don't find the separate faucets for the hot and the cold charming.
Not especially.
Well, what do you want to do this afternoon?
What can we do? It's raining.
We could play Sorry. We could play Steal the Old Man's Bundle. Maybe I can get an extension cord and hang myself. What kind of perfume is that you're wearing?
So, you've never heard of it?
No, what?
I can't tell you.
Yeah, feel normal. Excuse me, sir. Can I have a look at that business section?
It's so?
Thank you.
Thought you got out of that.
I did. I'm just curious. It's been almost a week. I want to check it out. It's going. It's up 6 points.
Told you not to sell.
You did not tell me not to sell.
I said the market fluctuates, remember?
Look, Vanessa, of course the market fluctuates. Everybody knows that. I just got fluctuated out of $4,000.
Probably why.
What?
Forget it.
No, that's probably why.
That's probably why we're staying here, because you lost money on the stock.
So what am I looking at here? 29 hours to go? Well, at least I got plenty of time to find out the name of that perfume.
Yeah, so sunk cost is something that is very typically used in financial economics, but it's something that people have a very strong tendency to do to include the sunk cost fallacy. So can anyone point out the sunk cost fallacy that Jerry was engaging in there in that scene? What sort of mindset he was engaging in to elicit that sunk cost fallacy?
I think he's already treating the fact that the market went down, whatever points he said, as like cost that's already become a sunk cost, even though he hasn't exactly like sold it off.
So I don't remember what exactly with the stock, whether he sold it off. I think he did sell it off by that point. But it's more about his decision to be there. Right. And so this is something that people have a very, very strong tendency to do, right? So he went on this trip that he is now very strongly regretting. Right. He is not enjoying his time at all. He's absolutely miserable, literally counting down the hours, 29 hours till I can get out of here. That is the sunk cost at play. He's already paid to be here, but sticking to that cost, sticking to that decision to be another 29 hours rather than saying, all right, and let it go. He could have had, if they had just left then, right? It would have been an awkward conversation. Hey, I actually don't like you. We should leave, right? It was going to be a miserable drive anyway, as he had already said. But this is a tendency that people make to include the sunk cost fallacy in their modes of thought, right? So if he was thinking about this rationally, the best thing would have, once he is miserable, to leave, right? But people often, once they have committed money or time to doing something, they want to see it through, regardless of whether or not seeing it through is adding any value to them, right? That's something that we've done and something that I've tried to include in my own decision making. I remember going to a concert sometime in the last year, and we were sitting there, my fiance and I, and all of a sudden we were like, "You enjoying this?" Not really, right? We'd spent the time to go up to Nashville to see this. We spent the money to be there, but neither of us were enjoying it, and there wasn't any point in sitting there not enjoying something. So we left and did something else, right? And so people can improve a lot of the decisions they make in their own personal lives as well as in their professional lives if they consider the fact that they are including sunk cost fallacy thinking in a lot of their decisions, right? People overall would be a lot better off if they learn how to cut their losses, right? That's a common phrase you hear, but something that often don't include in their own life, right? It's possible to make bad decisions and to continue making bad decisions, but once you realize that, oh, maybe I shouldn't be doing this, then at that point, you cut your losses and let it go, right? So the sunk cost fallacy Jerry was engaging is he spent the time and money to get to this bed and breakfast with someone it turns out he doesn't like, and now he has to endure a miserable day and a half staying there, right? When he could have said, you know what, this isn't great, we should get out of here, right? And people overall would be able to lead much better lives if they don't waste their time doing things that are costing them more in misery or an additional time rather than cutting their losses and moving on. People have a very strong tendency to engage in sunk cost fallacy. Everybody does, even though I always try to talk about reasons to not include sunk cost fallacy, it's something that I still include in my own thinking. People need very hard about what is actually relevant moving forward in the future and learn it's okay to cut your losses. All right. So one really important thing to keep in mind when you're putting any sort of model together, actually, this is actually going to be a good place to move over to some problems just to show some examples. All right, so I have all the formulas up here just as a reference to use. I have all the formulas up here as a reference to use. So what we're looking at down here is calculating the free cash flow based on just the information that we're given, right? So we're going to be using the bottom-up approach. We have net income, we have depreciation, capital expenditures, and then we're going to look at net working capital and what a slight change to net working capital can do to flow. All right, so free cash flow, we're just on the bottom-up approach. That's going to be equal to net income plus depreciation minus capital expenditures. And that gets us most of our free cash flow, but there's one component that's left, and that's calculating change in net working capital. So that we can calculate this is we can take the difference between the current assets, current liabilities in 1 year, and subtract out the current assets and current liabilities in the previous year. All right. So in this case, change net working capital. In this case, they just happen to cancel each other out. So let's see what happens if we make one slight adjustment, right? So one of those typical things is shortening collectibles. In other words, reducing the amount of time it takes your customers to pay you in full for the product or service you provided, or lengthening the amount of time that you take to pay for your products and their inputs. Basically, they're mere opposites of one another, right? Very often, one way that companies can increase their cash flow is by shortening the amount of time people take to pay off. On the flip side, they're at the same time trying to lengthen the amount of time that they're paying off their suppliers. So in addition to the free cash flow of a company, there is also the time component that's not included in this value-adding decision making. As you shorten your collectibles, you're receiving your money earlier. The earlier you receive your money, everything else equal, the more valuable that money is, right? $1 today is worth more than $1 from year from now, $1 6 months from now. And with our credit, you know, it's worth more than a dollar in a couple of weeks, maybe. Right.
Dr. Jansen.
Yes.
So here they decrease the current assets, but
Yep.
increase their current liabilities. So technically, isn't that like decreasing the amount of money received now, almost in a way? Because short term or the accounts receivables, it's like saying accounts receivables are decreased, I guess, in the current assets, or cash is decreased in the assets, and then you took out more like short-term debt in that, right?
So it's actually the exact opposite of what you just said. An important thing to keep in mind with a balance sheet is that a balance sheet reflects money coming in through the liabilities and where it is going within the organization.
What does like the 0.05 and 0.15 here really mean? Like current assets, is that like percent, not percentage?
So these are just dollars. It's just an example that's showing relative growth, so it doesn't really matter. You can think of these as dollars, if that helps.
Because you said shorten collectibles and lengthen credit.
Yeah. So you're reducing your current assets, shorten collectibles, and lengthening your credit, increasing your current liabilities. So it's reducing the amount of assets being tied up in accounts receivable and increasing the amount of liabilities outstanding under accounts payable. So assets reflect money being tied up.
Okay, I got it. So it's basically you trying to not pay off your debt as fast as before, so you free up free cash flow.
Exactly. And then the exact opposite with the shortening collectibles, you're receiving your money earlier.
Okay.
Yep. All right, so this is one of the things can add by increasing the free cash flow, just by managing their net working capital. So a couple important things here to note is just how companies grow over the long run. And basically, they can grow internally or externally. Right, so by growing internally, all companies are doing are just saving their profits. They take those profits and invest them in other projects moving forward in the future. All right, and that's reflected through the retention rate. What percent of a company's profits are plowed back into their balance sheets, plowed back into their savings, right? On the liability side of the balance sheet, it's a source of cash for a company to invest in assets. They can grow externally by reaching out to public or private capital markets, receiving funding, and then using those to invest in value-adding projects. All right, so one additional way we can calculate free cash flow is through basically this relationship between the growth rate of cash flows and the return on invested capital that we're getting from our investments that companies are making, right? So free cash flow can also be calculated by taking the operating profit and multiplying it by 1 minus the growth rate of the company divided by the return on invested capital. So if you were to invest within the company, what's the sort of return you can get on that individual investment? All right. And then in turn, we can plug this into the perpetuity formula. We take the value of an asset in perpetuity when we're dealing with public companies. That's one way that we treat them, is by looking at those cash flows as a perpetuity. Companies can exist in perpetuity. They can exist indefinitely. So we take those free cash flows, divide it by the growth adjusted discount rate, just that perpetuity formula that we've already seen. All right, so now we're going to see what happens when we change different inputs to a company's value, things that managers have some discretion over, particularly financial managers, and see what happens to the overall value of the company based on changes to those inputs. All right, so basically what we're going to be looking at is dividend policy. Say, so following along the perpetuity formula, we're going to value these cash flow streams. So we have operating profits, how much a company is reinvesting, and free cash flow rate just simply is the difference between the operating profits and the reinvestment. So from there, we can get our retention ratio. Right? Let's say that it's 50%. We have a return on invested capital of 10%, and we have a discount rate of 8%. Right? And we can get the overall growth rate for the company by taking our retention ratio, multiplying it by the return on invested capital. Notice that as we reduce our retention ratio, we'll be increasing the growth rate the company can achieve. All right, so let's see what this looks like valued in perpetuity. So we have the cash flow that is going to occur, divided by the growth adjusted discount rate. So the value of $10,000 paid out next year in perpetuity, growing at 5% per year, discount rate at 8% per year, $133,000. Right. Now we're going to recalculate this using the operating profit formula for free cash. So that's going to be our operating profit times 1 minus, let me double check. Yeah, 1 minus the growth rate divided by return on invested capital. All right, so we should get 10,000. Got an extra parenthesis. Right, so we should get 10,000 here because I've calculated the free cash flow. And now we're going to value it in perpetuity. We get that growth adjusted discount rate we've been talking about. All right, so we have the same answer.
Dr. Jensen,
Yes.
quick question. So I think the problem set that we downloaded, there's not like a free cash flow tab in it, but you did have it as part of our grade, I think.
Course notes practice. Oh, okay. I'll look into that. I may have left something in that I changed around. But I'll double check that. There should be one grade for each section that you're looking at.
Yeah, I don't see anything that's similar to this that you're looking on.
Okay. Yeah, I don't think I had included one for the problem set. But you
Gotcha.
see it in the grade for it on the
Yeah,
problem set?
It's
Okay.
just FTF, in like the project 1 tab, and you had like TVM, DCF, mod, stock, WACC,
Mhm.
or well, actually, you have RR. Is that the retention ratio thing?
No, I believe that's risk and return.
Okay, never
I'll
mind.
double check it after class. Make
No,
sure
you,
it's right down.
okay, no problem. Yeah, I just didn't see it.
Yeah, I'll check it after class. Thank you. All right, let's see what happens as changes using the 3 key roles of financial managers: the dividend policy, so how we manage companies' dividend; capital budgeting, so pursuing value-adding projects, applying these capital budgeting techniques we're going to look at in a minute here; and long-run capital management. In other words, managing a company's discount rate. Right? Remember the fundamental time value money. The higher the discount rate, the lower the present value. So as we lower a company's discount rate, we're increasing the company. All right, so nice thing with Excel, once you have a formula calculated in there, you can just copy and paste it on over. So what's going on here is we've increased the retention ratio of the company. So we went from retaining 50% of a company's earnings to 75% of the company's earnings. All right, so reducing the amount of dividends that a company is paying out is increasing the value of the company overall. What happens when we increase or decrease the retention ratio? It's lowering value. Right? Really interesting to note the difference in value being added here, right? So the retention ratio as a percentage has changed the same amount, right? We've increased 25% and we've decreased 25%. But we're not seeing a 25% increase and decrease going on here, right? So what's happening? And the answer to that is, look at the growth rate. Right, we've increased from 5 to 7.5%, but that is just per year. Right, so we're only seeing a 2.5 percentage point increase in value per year, but it's compounded in perpetuity. Right, and this is the power of compounding. The more we're compounding value, the quicker it can grow over time. So nominally per year, yes, it is only a 2.5 percentage point difference between the two, but compounded, 2.5 percentage point differences don't compound the same. Right, we're now compounding at 7.5% relative to 5% and 2.5% relative to 5%. Right, so those differences in the compounding values is really what is driving this difference in value. So by increasing the retention ratio, because we have a 10% return on invested capital, we are increasing the value of the firm. Now let's look at capital budgeting. Right, so with this, basically what we're trying to do is increase our return on invested capital. If we're able to improve our return on invested capital by adding value to projects, right, increase it, say, by 2%, we're going to be adding value to the company overall. On the flip side, if companies don't have value-adding projects to pursue, the value of their cash flows, their projects, in other words, are going to lose value, and in turn, the company itself is going to lose value. Right? This is typically why we tend to see failing companies' prices tend to decrease. It comes about that they no longer have value-adding projects to pursue, or it turns out that the projects that they have pursued and are actually the values of the company can in turn upon it. And finally, we have the long-run capital management. Let's say a company's debt, basically. Right? Remember the inverse relationship with the money. As we lower the discount rate, we're increasing value. Right? So we lower the discount rate from 8 to 6%. And again, we increase that company's value. And we do the same, or we do the opposite as we increase the company's discount rate. All right, so again, we've only changed the discount rate 2 percentage points. But again, because we're dealing with compounding, a 2 percentage point difference is orders of magnitude different. Any questions on calculating free cash flow or getting the value of those cash flows in perpetuity? So I think this is actually a good place to take a break for a couple minutes here. So we're going to take 10 minutes and I'll see you back here in a few. And we'll keep talking about some capital budgeting. All right. So really important thing to keep in mind whenever putting together a financial model, and this applies to any model, and it's a phrase that is very commonly used because it is so true, is that if you put garbage in, you get garbage out. Garbage in, garbage out. When you have a good model and you put garbage information to it, it's useless. Right? Similarly, if you have great information, but you put it in a terrible model, again, getting garbage. Right? So it's important that we have models that we can use to estimate something that we're trying to approximate the value for or get some information about. and that we have reliable inputs to that model. All right, so we need both somewhat valuable models and information we can use. All right, so when dealing with any sort of budgeting or valuation model, net present value is one of the cornerstone go-to methods for estimating those values. Basically, it's an expanded version of discounted I've already spoken about. But then from there, after we choose what model we want to use, it's important to have reliable inputs to put into that model. Right? In other words, is the data that we're using make sense? Is it in line with different sources? Right. So for example, if the stock market tends to average somewhere between 8 and 12%, does it make sense to use a return of equity of 39%? Right. In almost every situation, that wouldn't really make much sense. What if you're projecting a increase in cash flows when you're looking at a company in an industry that is declining? The company itself has been plummeting in value. It's been losing money. It's been bleeding resources, can't raise any money, right? It doesn't make sense for you to have a positive outlook when everything is telling you it's wrong. And so to put that into your model doesn't make sense. In some cases, right, there might be particularly situations where you might say, yeah, but you have to be able to justify those inputs, right? So some of the easiest ways to do this, and one of the standard ways that people make sense of their data and cross-reference it, is by using reputable sources of information. So what you're going to be using in the Capital IQ model, the basic information you're getting is pretty solid. And we're also going to look at several other external sources of information that have readily available and free source data that can be useful as well. Right. And so by getting these external resources, by not imposing too much of our own beliefs on the models and the valuations that we're going to be doing, we might be able to get a better estimate for how the company is going to be looking like when it's valued. And it is always important to keep in mind that even a perfectly executed model can still be giving you the wrong answer, right? In other words, should you invest in a project in a company or not, right? In other words, you could do everything right, but still be wrong, right? Or maybe you're eventually going to be right, but you're just not right at this moment. So important to really understand that. You know, an important thing in doing any sort of data analysis is that your steps correctly, even if you don't get what you're looking for, even if maybe you're wrong in this moment, right? You're likely going to be correct more often than not if you're relying on valuable sources of information that tend to agree with the general performance of something. All right, so going on to the capital budgeting tools that we're going to be looking at. Net present value is the difference between an investment's market value and its cost. Very simple. This is basically what it says there. It's a discounted cash flow problem, right? So what we're dealing with is the cash flows that a project is generating net of the startup costs. There's going to be one key difference between net present value and discounted cash flow, and that's going to be the startup costs that are applicable to ramping up a project off the ground before it starts to generate cash flows. Typically, that's going to be reflected through capital expenditures. Sometimes it can also be included with working capital, getting that started up in that first year. But it's also important to keep in mind that even though we are going to have ramp up costs for a project, capital expenditures can reoccur in the future, particularly when we're valuing a company, right? We should expect some capital expenditure, even if it's the negative capital expenditure, meaning the company is in decline and is slowly starting to sell off the assets that it's accumulated, which would go in under something like salvage value or disposal costs. So what net present value reflects is the expected value being added or destroyed if it accepts a project, or reflects the overall value of the company. Across all boards, it's generally the best valuation technique. A lot of reasons for that. Right. Biggest one is that NPV is getting to the straight bottom line, right? If the goal of a company is to generate value, NPV is how we measure that value. So the answer to figuring out the value of something using NPV is immediately going to the bottom line goal of the company. Is it adding value or not? And this leads us to very simple decision criteria to use. If the net present value is greater than 0, accept the project. If value. In other words, if the NPV is greater than 0, if you're to accept the project, the company's value is going to increase by whatever amount the NPV is equal to. If on the other hand, NPV is less than 0, the project should be rejected, because if you were to accept that project, the value of the company is going to decrease by the projected NPV amount. We also have the, if NPV is equal to 0, right, then technically you're going to be indifferent. But it is important to keep in mind, particularly when we're actually applying this for companies that have limits, the further away from NPV, the further away from 0 the NPV is, that's more likely the direction of value being added or destroyed by a project, right? So in other words, because our models can be wrong, right? We might be directionally correct, even if we're not nominally correct, if we find that NPV is very far either direction, right? If it's very negative, the project is highly likely to be destroying value should it be accepted. If it's highly positive, it's likely to be value if it's accepted. So the further away from 0 you are, generally speaking, the more confident someone can be that NPV is giving them a directional answer that will either be adding value. Okay. So there are a couple things that can happen to improve NPV estimates. So sensitivity analysis, also taking averages, which we'll. All right, so upsides to net present value, it gets straight to the bottom line. It reflects the dollar value being added or destroyed by investing in a project. So it cuts through all the nonsense that might be included when considering value, whether to accept the project or not. It's a very simple decision criteria. Is the NPV greater, equal to, or less than 0? Right? If it's greater than 0, accept, less than 0, reject, equal to, technically indifferent. Another very important thing that NPV provides that the other capital budgeting tools do not is a sense of scale. Right? And scale is very important when you're dealing with limited capital resources and you want to allocate them to the most value-adding projects. Right? So in other words, if you're a $1 billion company, the magnitude of value being added or destroyed for capital in those projects is important. Right? Adding $1 technically is beneficial, but you'd rather add $1 billion in cash flows being generated by your company. Right? So scale matters, and as we'll see with these other tools, they don't give us a good sense of scale. So being able to get a sense of the order of magnitude of NPV being created or destroyed can help us rank order projects by how much value is being created or destroyed. A downside, and these downsides to NPV are applicable to the other ones as well, and you'll see why in a moment. It's just an estimate, right? Any model that we're dealing with, always important to keep in mind that we're dealing with an estimate. If we implement NPV poorly, we're going to get poor answers. If we use poor inputs to NPV, we're going to get bad estimates as well. And whenever we're dealing with evaluation, we're dealing with an estimate. It's also going to be sensitive to inputs, right? So as we saw when we were doing those examples with the free cash flow earlier tonight, we can have small changes in rates that lead to drastic changes in value, right? A 2 percentage point difference in the WACC more than tripled the value of the project. On the flip side, a 2 percentage point decrease, or I said that opposite, a 2 percentage point decrease more than tripled the value of the project. 2 percentage point increase in the discount rate, almost half the value of the project. Right, so small inputs can lead to drastically different answers. So that's why it's very important to try to be conscious of what inputs we're using in any model to give us a sense of how likely we are that we're making the correct decision. And finally, this is just a technicality. It cannot give, NPV cannot give decisions when projects are mutually exclusive and there's different capital expenditures into each project. However, this is something that we can work around simply by dividing NPV by capital expenditures. When we do that, then we can use a scaled version of NPV and that helps override it. But it's technically a different metric than NPV itself. All right, internal rate of return. For a long time, this was the most popular metric. As you'll see kind of in the a couple of the papers that we've looked at, NPV has started to overtake NPV, or NPV overtake IRR as the most prominent capital budgeting tool. I haven't been able to find a survey that's more suspect that NPV is increasingly used in place of internal rate of return. But anyways, internal rate of return, this is the that makes net present value equal to 0. Again, comes back to time value of money. As we increase our discount rates, we decrease our present values. As we decrease our discount rates, we increase our present values. Always this inverse relationship between present values and discount rates. So when we're dealing with the internal rate of return, what we're trying to figure out is what is the discount rate that's going to set the overall project's value equal to 0. In other words, it's going to set the end equal to 0. So the higher the internal return, the better the returns are going to look like. All right, so similar to NPV, the internal rate is a very simple capital budgeting rule to follow. The internal rate of return is greater than the discount rate, accept the project. If the internal return is less than the discount rate, reject the project. Similar to NPV, if internal rate of return is equal to the discount rate, then we should be indifferent. It's important to keep in mind that we cannot manually calculate the internal rate of return. This is what's called an iterative function, and I'll show you exactly what that means when we get back into Excel. But basically, it's a goal seek function that gives us the answer for what we're looking for how we set NPV equal to 0. Right, so we can't calculate this by hand. We've actually just got to use something like a calculator, Excel, and use the internal rate of return function to get the internal rate of return. And it's important to keep in mind that we're using undiscounted cash flows for the internal rate of return. All right, so we have to use the nominal values of cash flows. If you use discounted cash flows, then basically you're double discounting those cash flows because the internal rate of return is functioning like the discount rate. Right, so just to show graphically what I'm talking about when we're talking about NPV, at this point where the NPV is equal to 0 is a reflection of internal rate of return, right? So in other words, if the discount rate is 12%, then this project that we're looking at would be equal to 0, right? This inverse relationship between discount rates and present values in action. So on the upside, internal rate of return is easy to interpret, similar to NPV, and it's also presented in rate form, and people like rates. Just the longer that you're in the field, the more natural it is to look at a rate rather than a nominal value. So using a rate is a pretty easy way to look at things. It can't be calculated manually, right? Where you can calculate NPV on pad of paper, gonna definitely help if you have some sort of calculator to help calculate those discount rates, but you can do it with just calculator, pen and paper. You can't do the same for internal rate of return. It's an iterative function, so you need something like Excel or a more advanced calculator that can calculate that for you. One of the largest downsides to it is you can get multiple results for the same inputs. You can get literally 2 answers. I've seen this when I've done examples in class. You can get 2 answers for internal rate of return when you have the same exact inputs. That's just a problem with iterative functions. It's an embedded issue with using this metric. And again, one of the downsides. It can't be used for mutually exclusive projects similar to NPV. It cannot deal with unconventional cash flows. In other words, going from very profitable, unprofitable, very profitable, unprofitable. You have to have the outgoing projects, in other words, capital expenditures early on, and then profits from there. If you have unconventional cash flows, internal rate of return will give you an error. All downside is it doesn't scale, right? If you're looking at a project that has an NPV of 1,000%, right? The return you've ever seen on a project, only earning 50 cents on it, right? That 50 cents, while technically it is adding value, right? 50 cents is not much worth chasing. And internal rate of return doesn't give you a sense of scale, whereas NPV does. And finally, internal rate of return is just inherently tied to NPV, right? So if we're relying on NPV anyways, you may as well use the source motivation for it and use what's getting to the bottom line goal of the company. Lastly is the profitability index. So I say lastly, there are many different capital budgeting tools. These are 3 of the most popular ones. NPV is by far and away the best metric to use. The profitability index, this is giving us an index of relative cash flow inflows to cash outflow. And this is of future cash flows divided by our startup costs. In other words, it's a benefit to cost ratio rather than a cost to benefit ratio. Benefit to cost. All right. So in other words, the higher the profitability index, the more value adding a project is. So if the profit is greater than 1, project should be accepted because the present value of the cash flows are relatively higher than the initial investment. Profitability index is less than 1, should be rejected. Again, similar motivation. The present value of the cash flows is less than the initial investment. And again, we have this technicality where if present profitability index is equal to 1, then indifferent. Again, like internal rate of return, profitability index should give us the same answer on whether or not to invest as NPV. It's just giving us a different perspective to evaluate it from. All right, so it's easy to interpret. On the downside, it doesn't give us a sense of scales, right? $1 billion project may have a same or worse profitability index as a $100 project or a penny project. And again, we cannot compare mutually exclusive projects. Oh, one more I almost forgot about. Payback. So the payback period is a little bit different than the others because it does not have a go-to valuation metric, right? NPV less than 0, except IRR greater or less than the except reject. Profitability index greater or less than 1, right? So all of these other tools have had very clear-cut rules to follow to give us an answer on whether or not to make an investment. The payback period does not. It is a qualitative metric. So despite it being something that we're calculating, it doesn't have an associated, this is when you need your money back. It's entirely up to the investor to determine what is an acceptable time frame to recoup their investment. Right. So in other words, it's an arbitrary payback criteria. The way we calculate it is we take the average cash flows over the course of a project's life, divide it by the startup cost, and that's going to get us the number of years to recoup plus left over cash flow in the last year. Right. So in other words, if you get 3.5 year recoup, that means 3 years in, you're getting most of it, and then halfway through the 4th year, you're recuperating the last of the cash flows that you invested. That's like I said, there's no concrete rule to decide what is an okay time frame to recoup their investments for. This is a really valuable capital budgeting tool for risk projects. Basically, because the further out you expect the cash flow to take place, the less likely that cash flow is to occur, everything else equal. So something like venture capital funds, this is going to be a more useful project to use. Or if the funds to invest are only available for a limited time, right? So if you only have some excess capital for a year, you need to recoup within that time period, then the payback period is a much more valuable tool. And you have some objective criteria in that case because you just have this extra money for a certain amount of time. All right, so on the upside, payback period, simple and easy to use. It can help you determine which projects are going to recoup their money the fastest, right? So everything else equal, payback period coupled with net present value can be a great way to help rank order projects, right? If you're looking at projects with similar NPVs, which one has a shorter payback window, which one has a quicker payback period, might help you to determine which of those two projects is more likely to increase value, right? Preferable. Time preferences for money, right? On the downside, it ignores time value money, right? This is an easy one to fix. We can adjust for the time value money. We can use discounted cash flows rather than nominal cash flows, right? So that is an easy one to recoup. But because it ignores time value money, it also ignores risk, right? If you don't include a discount rate, you're fundamentally ignoring risk because of how we calculate those discount rates. They're inherently tied to the riskiness of those cash flows. And there is no hard and fast rule when determining the acceptable period, right? This is the biggest downside to the payback period, is that it's completely arbitrary. But another very large downside is that you can miss out on profitable years in the future, right? Especially when you're dealing with young growing companies. They tend to be very unprofitable early on. right? So if investors only ever use the payback period and have never been funded, right? So stuff like that, important to keep in mind. Very often when you're dealing with young companies, profits don't start until later on. So focusing on the payback period at the expense of these other metrics we can use to estimate value can be detrimental to investors. All right, any questions before we swap over to Excel? All right, so we're going to work on a few projects here, or one project, but use the different metrics we were talking about. All right, so let's say that a firm is evaluating a project. It's going to generate 250,000 to start. It's going to earn 100,000 per year for 4 years. All right, if we have a discount rate of 16%, what's the value of those cash flows? All right, so NPV, very similar to a discounted cash flow problem. We set up the cash flows, or we set up the time periods, we allocate our cash flows, discount our cash flows, add it all up. One key difference here is now time zero is important. Now time zero is relevant. The reason being is, if this project is started immediately after making this decision, we have this ramp up period. During this ramp up period, we're going to need to spend money. We're going to need to make investments in order to get access to these future cash flows. So when we're dealing with net present value, time zero has not occurred yet. This is all forecasted into the future. So the startup cost is being allocated to time zero and is relevant to the present value because none of this has occurred yet, right? We haven't made the decision to invest. Once you've made the decision, if the 250,000 has already been invested, then all you're evaluating are the future cash flows, cash inflows from that investment. But this investment has not yet occurred, so it is still relevant to the value of the project. All right, so this is the key difference between net present value and general discounted cash flow analysis. In net present value, we are still including these startup costs. All right, so we have our time periods, we have our 4 years, we have our cash flows allocated, cash inflows, 1, 2, 3, 4, and our startup costs, 50,000 and time zero. All right, we're gonna get our discount rate 1 divided by 1 plus 10%. Rates of the year. Decreasing over time. All right, we should always see that decreasing value over time. Further out into the future, we receive our money, the less it's worth. Now we get our present, our cash in, minus our cash outflow, times the discount rate. Whoops. Times the discount rate. All right. So now we have our present values. Now we sum them all up to get our net present value. Okay. So based on net present value, if we were to accept this project and start building it right away, it's going to add $529,818 in value based on a 16% discount rate, the expected costs, and the expected incomes. All right, so based on this NPV, should the project be accepted or not?
Yes.
Yeah. Yeah. Okay. All right. One other way that we can kind of simplify this is using an if state.
Wait, Dr. Jansen,
Yes.
why is the present value in that one, in the first, in D41, that positive again? I guess in my head, I was
Oh,
thinking
whoops.
it should be like a negative.
Nope, I made a mistake there. Thank you for pointing that out. So I have a negative cash flow in CapEx and I subtracted the negative. That's why. Thank you for pointing that
Okay.
out.
Yeah, I was
Yep.
about to say that's really high for NPV.
Yep. Thank you for pointing that out. So I have the negative value for, right? You have parentheses around value in Excel that indicates to Excel that it is a negative value in cash. Right. So I subtracted the negative, which in turn made it positive. Yeah. So still positive NPV, 29,800. All right. So we should invest, right? But one of the ways that we can kind of get a better way to go about this is using if statements. All right, so if statements are basically as defined as we see here. It's going to give us a logical test, right? So if that condition is met, then we're going to get something for if it's true or false. Right, so the condition we're testing with these capital budgeting tools, are they adding value or not? Right, so with NPV, is NPV greater than or equal to 0? If it's true, and if it's false, right? So now we have our if statement set up, right? So if this were negative, right? So let's say that it's now our if statement is going to automatically update for us. All right, there is one condition that we're, right? Technically, there is a third condition when we're dealing with NPV or most of the other capital budgeting tools, if it's equal to 0. We're going to expand this if statement into what's called a nested if statement. All right. So basically, it starts out the same with our logical test. If our NPV 0, invest. If false, this is where we get our nest. We get another if statement in there. But now from here, it works out the same. The only difference is we remember what conditions we're dealing with. So if the NPV is less than 0, then we're not going to invest. And if false, we're indifferent. Right, so just to test this out, equal to 0, we're indifferent. It's negative, don't invest. Right, so now we have our nested if statement, and it's automatically telling us whether or not we should be investing or not in the given project. All right, now we're going to look at payback time period. All right, with payback time period, we're trying to figure out how long to recoup our investment. All right, so it's very, very simple. We take.
Dr. Jansen, just one quick question again.
Yep.
So to get your ROI here, I guess you just take the 29,818 divided by 250,000.
So, yeah. It depends how you define return on investment.
Yeah.
So this is the total net present value divided by.
Okay. So yeah, that makes sense. You take the net present value, all the cash flows in the future, divided by whatever you've already spent now.
So
Yeah.
This is one of the ways that we can measure that. Yes.
Okay.
Good question. All right, now with the payback time period. All right, so with this, we're concerned how quickly are we getting our money back that we're investing. All right, so the way that we're going to do that is just take how much the negative value, since we have negative 250,000, and divide it by the average. Since we're having constant cash flows, we don't have to take any averages. Cash flow, or dollars here, we're dealing with years. So what it's saying, and we can easily see this as well, is we are recouping our investment halfway through the 3rd year. All right, so we got 100,000, 200,000, halfway through the 3rd year, we're recouping our investment. So if we have a 2.5-year payback period, should we invest in the project or not?
Yes.
Okay, what's that?
Well, if you're going into it for 4 years, I mean, you're profitable. I mean, if that's the plan, is to go for 4 years, you know you're going to be profitable if you're going to be paid back in 2.5.
Well, keep in mind here, right? So these decision criteria are all kind of going to be based on themselves, right? So by going on and saying that we're going into this for 4 years is kind of projecting our own kind of mindset on the criteria, right? We should be able to set up something like this that is giving us an automatic based on these inputs, this is our output, right? That's how models and answers for models should work. In the case with the payback period, remember that it's arbitrary, right? And it's arbitrariness, so it's up to us as investors. So basically, that was a trick question, and it's kind of up to every single one of us whether or not it would be acceptable, right? So for you, what you said might make sense for you, John, that yeah, 2.5 years, if I'm in 4, I get my money back within the time frame, it works out, then sure, that works. But maybe that doesn't work for me, right? Maybe I want to recoup my money within 2 years, right? 2 years is my deadline. I need it back within 2 years, in which case it wouldn't be acceptable. And this is the arbitrariness of this metric. There is no hard and fast. This is where we cut the line. It is completely up to the investors. So because of that, it's arbitrary, and we can't say based on this answer whether or not it's acceptable, unless we're told the cutoff is 3 years. If we can recoup our investment within 3 years, in that case, yes, it does make sense. On the flip side, if we're told we have to recoup within 1.5 years, then no. Right. So unless we're told a time frame that we want to recoup our investment by, then we don't know. It's just arbitrary. It's up to the investors. Some of us say yes, that works. Some of us might say not. Some of us might say I don't know, and there is no answer to that. Totally up on this one. All right. Internal rate of return. Notice I have this set up a little bit differently. I have every single one of the cash flows on the same row. So other than examples using internal rate of return, I like to separate cash flows into each of their different states, right? So we have cash inflows, we have the cash outflows. And as we'll see in the cash flow tables later on, there's going to be a lot more things that we can include here. But for now, we just have we have cash inflows and cash outflows. With internal, you have to, it'll be easier on yourself if you just reference the same row here. And we're going to be using the internal rate of return function, IRR, returns the internal rate of return for a series. Another great thing is it always tells us what we're doing. So now we got to highlight our values of our cash flows, and it gets us our answer. All right, remember the criteria for the internal rate of return. If it's greater than our discount rate, except the project is expected to be adding value. Generally speaking, it should also always agree with NPV, other than the rare situation where it gets us that second answer, in which case it's going to be giving you one of those two answers in this iterative function. All right, so let's set up, are we investing or not? So we're going to set up our nested if statement here. If our internal rate of return is greater than our discount rate, invest. If not, this is where we bring up our next if statement. We get our test. If it's less than 0, oh, nope, not less than 0, less than our discount rate. There we go. Reject. And then the last condition, indifferent. Right, so it's getting us exactly what we're expecting. Oh, I put 0 in there. Maybe not. Did I? Oh, maybe I should change that to equal to 0. Yeah, that would make sense. I'm just going to plot these logical tests around. Yeah. I done that after I. There we go. All right. So now it's
Okay.
getting us the answer that we should expect. Yep.
One last question. I'm kind of backtracking a little. I'm trying to follow along again.
Sure.
Could you go back to the PV on the MPV questions again? The D41, yeah.
Mhm.
Did you add those two together?
Mhm.
That makes sense. Okay. Times the D40.
Yep. So
Okay.
it's just like a discount cash flow. The only
Yeah, just taking it
in
out.
year zero, we're still including our cash flows because this is our ramp up period.
Yeah, you're not making anything on that year zero yet, so that's just like,
Typically not, right? So generally you're assuming that there's going to be a ramp up period. In the case of this class, just going to assume it's going to be a year. Sometimes it can be longer, right? It depends what sort of project you're going to be evaluating. Right? Some projects take a really long time to pay off. So biotech projects are often something like that. So medical procedure, sort of medicines, right? There's a long time, a lot of investment period where you're just spending money trying to develop and then test the product that is going to be going to market eventually. Right. So some projects have very, very long lifespans, but if it works out, right, if you happen to find the cure for cancer, that's going to be very valuable. Right. So
gotcha.
it depends on the industry, but for the sake of simplicity, we're just assuming ramp up in year zero in the first one, but it can go on for a very long time.
One more question on this time the payback time period one. So I know you said it's like arbitrary and stuff. So I know that we don't factor in like say the risk on return, like the say if somebody defaulted or something, like maybe even adding in almost like a default risk into it. Like how is that usually weighted into it? Like how do you factor that into like say payback time period?
So in payback time period itself, it's not factored in. So there are adjustments we can make to the payback time period. Right. One way we can adjust for risk is using the discounted cash flows. Right. So actually, I'll just go ahead and copy that stuff down. All right, so this is going to change our answer a little bit. So now we're going to take the average cash inflows. So if we wanted to adjust for cash flows, we can do that, right? Different
Oh,
years, we no longer have the fixed cash flow, so it's important we take the average value of these cash flows. So that's one way we can do it. The better way to do it is basically go along each year. So this is the almost accurate but very simple way of dealing with it. The better way to go about is to literally go through each year and subtract go through and subtract the cash flows in each year. Right. So at which point you start recouping, right? So somewhere along between the year 3 and 4, you start seeing that you're going to flip over from losing to starting to get money back.
So that 250,000, I'm curious as to like, technically doesn't that 250,000 that you invested at the very beginning, doesn't that also lose value as well?
So the thing is, it's relative to today.
Okay.
Right. So when we're dealing with time value of money, basically the scale is now relative to the future. So if this was reoccurring capital expenditures every year, then yeah, moving forward into the future, that 250 would be discounted. But because it's a capital expenditure in place 1 year times 0, it's only going to be relevant to today in this one.
Well, I was wondering, like, say, yeah, you did spend this amount of money, the 250,000, like, and then say if you had to adjust for like inflation in period, but you also needed to like do the NPV of all future cash flows to it. Would that be like a even more accurate like model maybe? Because then you'll really get your real rate of return through like inflating the 250,000 in the next 4 years, but you're also discounting all 4 years of future cash flows as well. And then you add that back to your original. Wait, no, I guess if you did pay for the no, never mind. You got it. No, it makes sense now. In my head just now, it just made sense.
I think I'm starting to see what you're asking with your question. In that this 250,000 in the past, how does that change in the future?
Yeah.
But
No, again, I think you already kind of answered it because like you said, it's right now. So it doesn't matter too much, even if it didn't get inflated in the future, because you still originally your NPV say 4 years from the future, 250,000 would be like, say, 280,000 or something like that. And then you can like, you still only spend 250,000 in your present time. So it's still the same thing. So I got it.
Yeah. So just a couple of things to note about that. Yes, the 250,000 is a lump sum taking place in year 0. Right, so it's only occurring once. But also, if we're bringing it forward into the future, we're then dealing with the future value problem. So in other words, this 250,000 would be growing if we're moving into the future. Right, that's the way that money works. When we're looking at future cash flows, we discount them back. When we're dealing with present values, we take future cash flows and discount them back. When we're dealing with future values, we take present cash flows and compound them forward.
Yes, sir.
All right, so we have our internal rate of return. Oh, I forgot to include profitability index. So let's just copy that down. Profitability index. All right. So I actually gotta double check this. I'm pretty sure. Yeah, it's the sum of the discounted cash flows divided by the startup cost. So should we invest in this or not, based on the profitability index?
Is this a trick question again? Arbitrary? Yes. Oh, okay. Yes.
So what is the decision criteria with profitability index?
As long as it's greater than 1.
So the only one with the trick question there is the payback time period one. That's the only one that is arbitrary, and we don't have a strict decision criteria. So that's right. Again, we can set up our logical test. So are we greater than 1? Actually, we can do this. We can do this differently, right? So are we equal to 0? Right? It doesn't matter what order we put these tests in, as long as we get the conditions met for the 3 tests, then we're correct. All right, so if first test, if profitability index is equal to 0, then it's going to be indifferent. If not, we open up our next if statement to get that going. So let's say that it's going to be less than 1. Oh, equal to 1. Yeah, less than 1 equal to 1, not 0. There we go. Less than 1. I'm going to reject. We got it. So let's test out 1, 0, reject. All right, so it's working correctly. So based on these inputs, should we invest in the project or not? Based on these capital budgeting tools that we just went through.
Yes.
Yes.
So basically we can answer that question, should we invest, is to focus on NPV. Basically, whatever an NPV says, that should be the gold standard for whether or not we should be investing. Everything is kind of a little bit of details, right? So payback time period, this is all arbitrary, right? If we're using the non-discounted payback, the traditional payback time period, if our time frame is anything less than 5 years, then yeah, sure, this is fitting that, but it's arbitrary. When we're looking at the internal rate of return, it's meeting that criteria as well. It's greater than the discount rate of 16%. The internal rate of return is greater than 16. So we should invest. Profitability index, again, it's agreeing with NPV. It has 1.12 for the profitability index, so we should invest. Right. So based on those, yes, should be invested. Any questions on the capital budgeting tools? So there, like I had mentioned, there are other methods that people use when gauging the value of projects. These are some of the most common. NPV is the most reliable one. It's the one we are going to be focusing on. As you can see here, basically, this is just all more and more detail about using NPV in practice. All right, this is basically what your project is going to come down to. You're conducting a net present value analysis of a company that you're evaluating. Difference being is, as you kind of get the hint on when we're dealing with more details going on, there's just more inputs for figuring out the cash flows and discount rates you're going to be using. All right, so everything we're doing is just coming down to just more and more details on the inputs that we're going to be using. So over the long run, capital allocation is really the most important aspect of a company. It's how financial managers can add the most value to an organization, is helping them figure out where can we channel resources the most effectively, the most efficiently, what's generating the most value. And really, this is how economic expansion occurs. People allocate their capital to value-adding projects, and over time, right, that's how companies grow and expand into jobs and stuff like that. Innovation is how humanity has gotten to the point that it is, right? The Industrial Revolution all came because capital was funneled into these more value-adding projects. And so this is basically what we expect when companies are operating as they should be, investing in value-adding projects. Right, so finding and investing in these value-adding projects, it's the best thing that we can help a company do. Figuring out, which ones are going to have the best return on capital is how we can add the most value over the long run, right? If you think of a company, their core projects, what they invest and make money on, are what define them. Apple with the iPhone, Google with the ads in the search bars, stuff like that. So if companies aren't investing, right, if they're not investing in their future and different value-adding projects, right, they're highly constrained in the amount of growth and value that they can generate for shareholders. Right? It is true that some industries themselves are inherently constrained in some ways. But that doesn't mean that there isn't value in them. It doesn't mean that they're not capable of still adding marginal bits of value over time. Right. So one good example of that are something like utility companies. Utility companies are highly regulated, both in how they operate, how they bill, and how they can, or what they can do with the earnings that they make. But despite of all these restrictions, right, they can still add value over time. They can produce the products and services that they're providing to consumers a little bit more efficiently. And those little bit of efficiencies can add up over time. Right. So generally speaking, if capital isn't constrained, then we should accept every single positive net present value project that we can come across. But and the fact is that in pretty much every situation that we're going to be involved in, capital is going to be constrained. Right. We're not going to have a budget that we're going to be able to deal with. In situations like that, the highest NPV project is the one that should be accepted. Right. Right. There are other factors that are, but really it comes down to NPV. What is going to be the most value-adding project we can consider? All right, so NPV, this is the go-to capital budgeting tool. When in doubt, NPV is what you should be relying on. Typically speaking, though, the investment criteria should agree in their answers, right? Whether or not you should invest, you should get the same answer across all these other than the payback period. Importantly, these are estimates. And as we've already seen several times already in this class, changing inputs a little bit, just a couple percentage points, can really give you different answers. Right, so there's a few ways that we can mess around with NPV that we'll look at a little bit more in the future. That right, as you play around with it, you can get an idea for how robust the decision itself is. Right, so in other words, how likely are you to actually add value under different conditions? All right. Any questions on capital budgeting tools? All right, so we're only going to have time to get started with this. We'll finish it up next class. But weighted average cost of capital. So far, I've just told you pretty much what the discount rate is that we're going to be using. But this is how we go about actually calculating that discount rate, the weighted average cost of capital. All right, this is our discount rate. In equilibrium, discount rates are equal to the required return or equivalent to the cost of capital. What really all this just reflects is the opportunity cost of the firm. In other words, the minimum amount of return that a firm has to return in order to add value to its capital providers. So in other words, this is the hurdle rate companies have to maintain in order to be generating value, right? You have to earn at least this much return in order to generate value. Right. So how are we going to calculate the weighted average cost of capital? We're going to simplify it and focus on debt and equity. That simplifies the equation a little bit. There are other sources of external financing that are relevant though, right? Preferred equity is one, leasing options are available to companies, but we're going to simplify it and we're going to focus on net of tax debt as well as equity. This is a pretty common method also for calculating weighted average cost of capital for a couple of reasons as well. Traditionally, debt and equity make up the largest components of companies' external sources of finance. So even just by excluding all the other sources of capital, external capital, you're still usually getting the vast majority of external capital that companies are going to be raising. But in addition to that, and really pertinent, as you'll see with all of the things that we use in the field, it's also easier to get information on debt and equity relative to some of the other sources of external capital. Right? We have a lot of information available on debt issues in a company's financial statement. As you'll see when you pull up a company in Capital IQ in that plugin, they're going to give you information on the last, I think it's 5 or 10 debt issues that the company has had. So you have that information available. Equity information is very readily available, right? You go look up a company's ticker, right away you'll get information on the company's market cap, on the price, on its daily return, on the average returns over a given time period. Typically, you'll also be able to get information on the company's beta right away. Often that beta is calculated monthly over the previous 5 years on a rolling basis. That's kind of the standard way for calculating beta, right? So that information is readily available. Preferred equity is easily calculated as well. It is another form of equity, but typically it's not included as often. Leasing and options, those get more complicated. You have to dig into financial statements a lot more. So including them in the cost of capital is much more burdensome in many ways. And they also make up a much smaller fraction of external capital. So because of that, right, it's making up a relatively small portion of capital. It's also very complicated. So it's small benefit for a large cost, right? Cost benefit analysis. So how do we calculate it? Weighted average cost of capital is actually pretty simple. You take the weight of the capital source, you multiply it by the cost of the capital source. So when we're looking at, oh, I thought I had a condensed version here. There we go. Okay, so it's ahead. All right, so what this WACC reflects, the weighted average cost of capital, is how much a company has to earn, right? A very important thing to keep in mind is that it's reflecting the typical risk of a company, and investors have to be compensated for risk, right? You have debt investors, equity investors. Debt is relatively less risky than equity. So given the risk differences, debt is usually going to be cheaper than equity over the long run. Right. So this weighted average cost of capital is also going to be reflective of the investments made by the firm. The company itself, its overall riskiness, its capacity to pay off creditors, its capacity to generate value for shareholders is reflective of the investments that the company has made over time. Right. So the WACC reflects the company's overall risk. And so this is where we tie risk in to a company's value is through the discount rate that we apply to its future cash flows. Remember, the higher the discount rate, the lower the present value, and the higher the risk, the higher the discount rate, the higher the expected return, right? So risk comes into play with valuing a firm through the discount rate that we're applying to its cash flows. The higher the risk, the higher the return, the lower the present values. Right? Always that inverse relationship between present values and discount rates. So when we're dealing with debt and equity specifically, what we're going to be doing is we're going to find the total market value of the firm. This is just going to be summing up the equity and the debt of the firm. And we're getting our weights, right? Any weight is defined by some numerator, some denominator. In this case, the numerator is the type of external financing, equity and debt. and the denominator is the overall value of the firm. So we're taking the weight is the value of each individual source divided by the total, multiplied by the cost of capital. Right, so we have the cost of equity and the net of tax cost of debt. So we're netting the cost of debt by net of tax. So why are we adjusting for taxes with debt but not with equity? The reason is the income statement, right? If you think of the structure of the income statement, you have your sales, cost of goods sold, selling, general, and administrative. A little bit below that, you're going to have your interest costs. In the United States, interest is tax deductible, meaning that a company's taxable income is decreasing when they're paying off their debt. In other words, their taxable income is lower, so they're paying less in taxes. So the reason we're using the net of tax cost of debt is because debt functions as a tax shield, right? For every $100 we're paying in tax, we're saving 1 minus the tax rate and value. So if we have a 30% tax rate, right, we're saving $70 in taxes.
Dr. Jensen,
Yes.
the market value of debt, is that including like short-term debt too?
Yes. So
Okay.
all outstanding debt on the company. And actually, good point and important caveat here. Technically, we should be using the market value of debt. In actuality, that rarely happens. And often what people substitute in is the book value of debt. And this is exactly what you're going to see in your base capital IQ model. Typically, what people do is they look at the value of debt outstanding. You can get that through Capital IQ or some other Bloomberg or some other investment information resource. It's also available in the tables in companies' financial statements that they file. So you can get an idea of the book value of debt, and typically you're just going to substitute the book value for market value. Theoretically, market value of debt should be used. In practice, book value of debt typically is.
So the book value of debt here would be just all of like the bonds the company has, like bonds or any kind of bonds the company has decided to I guess sell on the market for that day or month that you're trying to.
Exactly. Oh, yes. Well, it's going to be the most recent issues that you'll see in the 10K, and we'll look at this as we actually go into financial statements later on. You'll see there is going to be information on the total amount of debt outstanding, and you're going to see average value of those costs of debt across different maturities. So you're going to have information for the value of debt outstanding and the cost of that debt to the firm.
Okay, yes, sir.
All right, so where do we get this information? So actually, this is just what I was talking about. So cost of debt, we can get it in company's financials. We can also estimate it ourselves using a company's credit risk rating, right? There are other ways that we can estimate cost of debt, but the go-to method is just looking at company's financials and getting their cost of debt from there. With cost of equity, though, things have to be calculated. There are a lot of ways to estimate the cost of equity to a company. Some people just look at the average returns for the company stock and use those average returns. But two of the more common methods are CAPM and the Gordon growth model, with CAPM being the not even close to the most common method for calculating the expected cost of equity. But each have pros and cons, right? So with the dividend, like we had already mentioned, it's simple and really easy to calculate. On the downside, most companies don't pay dividends, so it's increasingly inapplicable. You have to assume a constant growth rate, highly sensitive to the growth rate you choose, and there's no explicit risk consideration. CAPM, it adjusts for risks, right? So available, it's an advantage relative to the disadvantage of the Gordon growth model. And it's applicable to all firms, right? Whereas a lot of companies don't pay dividends. So it adjusts for risk, it's applicable to all firms. It is also relatively easy to calculate once at least you get the hang of it. The downside to it, is in having to estimate some of the inputs, right? So we have to estimate beta. We also have to get an estimate for the market return, and we have to have a valuable resource for the risk-free rate. Right, so getting those can be pretty complicated pretty quickly. Thankfully, there are external resources that kind of can simplify it just by nature of having that information readily available for you. It is highly reliant on past returns. So in theory, the CAPM should only be using forward-looking estimates, but in practice, people just use historical information and plug it into CAPM. And again, it's built on many assumptions and has a tendency to not work well in explaining returns. All right, so if we want to estimate expected returns with the Gordon growth model, we would just rearrange the perpetuity formula like we did earlier to get the next period's dividend divided by today's price plus the growth rate. There are some really valuable things about this model in that dividends tend to be sticky, meaning they don't fluctuate all that much over time because there's very strong market reactions if companies increase or decrease their stocks. So growth rates tend to be pretty stable. Today's price, it's immediately available, right? Everyone can go search up a company's stock price right now and get that answer. So we can put together forecasts for the company's future dividends by the history of dividends plus the growth rate, should they pay dividends. Right. Again, CAPM is a little bit more complicated if you're not familiar with it. But once you get into it and start calculating it a few times, it gets simpler. Right. So it starts off with the risk-free rate. We add in our amount of risk through beta and our compensation through for bearing risk through the market risk premium. Okay. So why are we using debt and equity? Again, it's the hurdle rates for the company, so they have to pay back their creditors. They have to generate value for shareholders, right? We have to pay at least that much before we start getting residual value available to the overall company. All right, so before we get into that, let's do an example here for WACC. All right. So let's say that a firm has a cost of equity of 12%, market value of 100 million, cost of debt of 5%, market debt of 50 million. What's going to be the WACC? All right, so we have our information, cost of equity of 12%, market value of equity of 100 million, cost of debt of 5%, value of debt of 50 million. All right, so the total value of the company is just going to be the sum of the value of debt and the value of equity. With the overall value of the firm, 150 million. All right, so now we get our weights. So the weight of equity is just the market value of equity divided by total market value of the firm. The weight of debt is market value of debt divided by market value of the firm. Whoops. Oh. There we go. Important to keep in mind that these weights should always add up to 1. Right, whenever you're dealing with a weight like this, we should see that it adds up to 1. So just highlighting it, see it sums to 1. Now we get the WACC. We take the value of equity times the cost of equity plus weight of debt times the cost of debt. And we have the WACC. Relatively straightforward once we get into it. All right, let's see what happens now if we add in a tax rate. Right, so remember, interest is tax deductible. It reduces our taxable income. So because of that, we're in practice going to be adjusting for our tax rate here. Right, but other than that, it's going to be functioning the same exact way. So we get the total value of the firm, 150 million. We get our weight. That should stay the same. And now we're going to calculate the WACC. So now that we're adding in this net of tax cost of debt, should we expect the WACC to increase or decrease?
Decrease.
Yeah, we're bringing in the tax rate, right? Which everything else equal is going to reduce the cost of our debt. So we're going to calculate the WACC almost the same exact way. Only difference here is we're going to take the net of tax cost of debt. So a few things to think about in playing around with the company's cost of capital, right? Everything else equal, debt is cheaper than equity, right? In practice, though, very important to keep in mind that this is not a complete static trade-off, that the more debt a company issues, the more difficult it becomes to pay that debt because they have these fixed costs now they have to pay back. And so basically you can get into a spiral where if companies are over financing themselves, over leveraging themselves, they're increasing their probability of financial distress, of going into default. But if that is not a risk for a company, right, companies can manage their cost of capital, right? Maybe they could raise more in debt relative to equity. And so by increasing the company's debt, it will reduce their cost of capital, which is their discount rate. So everything else equal, by increasing the amount of debt they have outstanding, they're reducing their cost of capital. And by reducing their cost of capital, they can increase the value of the company, as we saw with the free cash flow over here, right? Reduce your capital, reduce your cost of capital, you increase the value of the firm. Oh, actually, I forgot I was going to do an example on just that on the next problem here. All right, so we can just copy and paste these over, save a little bit of time. Right. So as we increase the amount of debt we have outstanding, it's going to reduce the WACC. On the flip side, right, if we were to increase the amount of equity we have, it's going to increase the WACC. Right. We're now back to this 2/3 and 1/3. So let's go a little bit higher. So the more equity we have outstanding relative to debt, the costlier it's going to be, everything else equal. Right. So as with any weight, right, if that weight is skewed entirely towards one source, then the WACC is just going to reflect that source. So if a company is fully equity funded, their WACC is going to be equal to the cost of equity. If the company is fully debt funded, their WACC is going to equal their net of tax cost of debt. So very important to keep those trade-offs in mind. All right, so I think that's a good place to stop for tonight. It's getting late, and when we come back next class, we'll pick up with doing another example, weighted average cost of capital, a little bit more complicated, adding a little bit more information in here. Are there any questions before we get going for the night? All right. I think everybody has submitted the company they want to evaluate at this point. If you haven't, make sure you get that done before this weekend. Oh, before I forget, I am posting some discussion board questions. So those are going to start being due over the next couple of weeks. I'll have that posted. And once they're all done, I'll send y'all an email just letting you know. So I'll get those posted and finished up, and along with deadlines for the response to them. And yeah, I think that's it. I'll check out the problem set for that question you asked about earlier. Any other questions?
Yeah. Are you going to post this video tomorrow?
Yes.
Thank you.
Anything else?
So the homework for this week is, I guess, this week's reading and the problems we can do in the problem set.
Yes, and also make sure you've got everything together for your Capital IQ, that you have your company group if you want one, and that you have access to Capital IQ. If you're still having any issues with that, I think it sounds like everyone's got it figured out by now. But if you still have issues, check those emails that I sent last week. I can't remember their names, but they're people at Capital IQ that can help you out.
So I think my Capital IQ still doesn't like me, I don't think, at all. So, but my partner's Capital IQ still works. So I think we'll just work on one together or something. Yeah.
It's fine to work it out that way with whoever you're working with. All right, well, if there's not any other questions, I hope you all have a good night. I'll send out an email tomorrow once I finish up the discussion board, outlining that. All right. Hope you all have a good night.
All right. Good night. Thank you.
Sir, good night, sir.
Thanks. Good night, everyone.
Good night.